I think we're missing the ball, and where I think we should be fighting it, is the fact that there are 100, because I just happened to look this up the other day for something else, 177 public Chinese companies in the United States with a total market cap of $1.42 trillion. That's money in the bank for Chinese companies to grow their organizations. And it's not like they're not at least partially owned or run by the government. And so I think we would have a better battle that would be more, that would show better results if we put constraints on Chinese companies in the United States. Could you imagine, A, if we said no more Chinese IPOs until this trade war is settled? B, you have to make whole or issue stock to make whole to American shareholders while we stop your stock from trading until this is resolved. I mean, there's downstream consequences that would have to be worked out, but all of a sudden, I mean, that's $1.4 trillion worth of value that is put in suspended animation. And I think, and it happens without hurting aluminum prices, without hurting farmers, without raising prices for consumer goods. So, we're just talking off the cuff here, but I think it's a different approach that should be examined.
Do you think that that's something realistically that the president would consider?
I don't know. I haven't talked to him about it, so.
Let's talk about the IPO market.
Right.
It could be a record year for IPOs in terms of money raised. Uber's going to go public on Friday. A lot of people, though, think maybe Uber waited a little too long.
They waited way too long. Lyft waited way too long. The whole concept of IPOs historically is to be able to provide growth capital to growing companies. These aren't young growing companies. These are old guys, right? They're old companies that are looking for capital to sustain business models that I think still have upside, but their growth is going to continue to slow. I mean, Uber and Lyft and Pinterest and Airbnb should have been public 5 years ago.